A very warm welcome to this fourth Openhouse 4.0 session. This is our 11th session overall. This one is focused on lenders. Lenders are easily the most important player in a lending ecosystem. We have enormous respect for you, and there are many reasons for this, but one of the important ones is that you are in a tough business. If you have one delinquent loan, that often takes away the profitability from maybe 20 to 40 good loans. So the first topic, we're going to discuss 4 topics today. And the first topic is really delinquency itself. And we manage this in this system that has been created for short-term cash flow lending by focusing on the financial product. So the fix is have a new type of a loan product. And in this loan product, if possible, focus on being able to control the future cash flows, incoming cash flows, control the end use of the loan that you provide. And if you're able to do both, then we call it a type 4 loan. We've referred to this in the previous open house sessions, and this will come up here again. In addition to that, the necessary aspect of short tenor loans is that is going to borrowers who cannot avail of a long tenor loan, and so therefore they treat it like a revolving loan. And revolving loans, if managed well, which is what we expect you to do, is something that can ensure low delinquency. In fact, we will share data with you to demonstrate that has been the case in some of our pilots. So one aspect we will focus on, the first one is delinquency and how to keep it low. The second thing that we will focus on is how to price the risk and therefore how to assess the risk. This is a very important issue, especially in this new era of a new data economy emerging in India. You already know about the account aggregator, which is built on the DEPA protocol, but DEPA is also unlocking a larger set of changes which are going to come once the DPDP Act gets operationalized. So the issue for you will not be access to data. It has already become a lot better, will become dramatically better in the months and years to come. But the issue will be how to make meaning of that data. And that's going to be important. That requires you to think about your underwriting models from scratch. And many lenders are doing that. In fact, some of the lenders are really, really sophisticated in how they are using these new data sets or new types of data that are becoming available to them. But to motivate all of you to move in that direction, what we're going to do today is to give you an underwriting model for invoice financing, as a gift, so that you can study it and understand it and apply this as you go forward. So because it's a very important journey to take in terms of reimagining your underwriting models. So now let us say you've got low delinquency, you're pricing the risk well, and that sets the stage for profitability. But for that to happen, you have to keep the costs low. Now that's a tough thing to do. Some of it happens simply because of the fact that we are going digital. But we figured that there are 2 other aspects that are very, very important. One aspect that's very important is being able to have clarity as to where should you have local to borrower agents and where should you have remote to borrower agents. And in our 2 years of pilots, this is one of our biggest insights that has come about. And we've shared that in our previous open house sessions as well. You will briefly, hear about that aspect being recapped here. So that's really very important. The other thing that is there is this misconception that we have that we cannot be as profitable with short tenor loans as we are with long tenor loans. And we are going to basically share with you why it is actually possible in some situations that you can design where your profitability for short tenor loans can be higher, perhaps twice as high as long tenor loans. And this is a counterintuitive idea, so please pay attention to what Rahul is going to describe here later in the session, and think about profitability right from day one. So if you have low delinquency, you have ability to assess risk, you have a cost structure that is very competitive, and therefore your profitability is good, and that then takes us to scale. and scale is going to be very important in this market. Why is it important? Because you're dealing with small MSMEs, and how do you get scale? How do you get access to thousands, tens of thousands, hundreds of thousands of borrowers in a cheap and effective way? And the answer to that is not only having co-origination partners, which is currently the norm, but to also have borrower agents as partners, because they also give you access to borrowers, without any co-origination involved. And Oken is specially designed to support both of those use cases. So it unlocks a new kind of a modality for you to be able to get scale, to be able to get access to borrowers. Now, this is different again. This is different from an exclusive kind of access that was the norm in the past, is no longer the norm, and in our view, will not be the norm in the future. So you will have to wrestle with that change and accept that change. And we'll talk a little bit about that in this open house session. And if you do accept this, then it becomes possible for you to really go after scale in a big way. So these are the 4 topics that we will cover in this open house session. We are very excited to have you here. There's lots of excitement about this Oken actually becoming the basis, this version 4 being the go big, and mainstream of short-term cash flow lending. So welcome, and with that, let me hand you to Sagar, who will take it.
Thank you, Sharad, for setting an overview. We'll get into the details of every part that Sharad spoke. We'll get into details of many issues, hindrances that lenders face today. Some are perceived, some are real. How to work around this, how to help you succeed in this is what this open house is all about. We'll also talk about how big the opportunity is and why Oken is poised for success. One thing is sure, cash flow lending is here to stay, and we should embrace it with both arms. The credit gap is real. The demand is real. Those who crack it early will be winners in the long run. With this, I'll hand it over to Rahul, who will take the presentation from here.
So thank you, Sagar, for running us through the challenges which lenders might perceive to be real. Now let's look at these hindrances a little bit in more details and understand how do they navigate through these challenges. So every lender today aspires to have an exclusive access to network of borrowers where the risk is low, profitability is high, default guarantees are available. But this is a very limited and a very finite pool of market available. The opportunities beyond this set of borrowers is humongous, which can be tapped by all these lenders. So Oken solves for this by getting an easy access to these borrowers, not just in single network, but multiple networks for multiple loan products. Just look at an example of Gem Sahay. Gem Sahay has enormous volumes, but it's a non-exclusive network and is available for any of the lenders to participate and do the lending over there. Similarly, could be the case for any big FMCG company where there's a last mile borrower in a certain remote location where the access could be available to any of these lenders through this network. So Oken solves for the quest to reach out to these borrowers which are available beyond the exclusive networks. And it's a one-time integration and provides an access for multiple products, for multiple networks, henceforth. So with the quest to build good lending portfolios, it also becomes very important for the lenders to understand what kind of collection mechanisms are available on Oken and how efficient are these costs for the collection mechanisms available. In Oken, we envisage 4 kinds of loan products. So type 1 product where there is no control on the end use, neither there are any collection controls available. Type 2 product where there is a purpose control, means the end use of funds is getting monitored. However, there is no collection control available. Type 3 product where there is a collection control available by way of some kind of an escrow provided by the network owner. However, the purpose of the loan may not be monitored. And then comes the type 4 product where there is collection control in terms of some kind of an escrow provided by the network owner, as well as the purpose of the loan is also getting controlled in terms of the end use of the loan disbursement. So lenders can tap into type 3, type 4 products and utilize the local agents network to bring down the collection cost drastically low. Oken provides this opportunity by providing these kind of networks to the lenders. So with the evolution of different products, redefining the metrics to measure the success of the lender also becomes very important. Now, what are these metrics? Lenders need to look beyond AUM or balance sheet growth as a principal metric. In terms of scale metrics, net disbursements and net total income could be the new metrics that the lenders can look at. In terms of trying to measure the efficiency, the cost to income ratio or the return to capital employed and the return on assets become important metrics that lenders can measure on. Other than that, for the lenders, there are new metrics which will come in play, which are new borrowers acquired, multiple loan cycles given to the same borrower, geographical access to different PIN codes where the lender was never having an access without having its own office. So these new metrics could be the metrics which can be used to measure the success. So moving from redefining the metrics, let's look at one of the very, very important point the lenders want to understand, where that's on profitability and the balance sheet growth. Now, when we talk about profitability, especially for sachet loans compared to traditional business loans, let's understand what brings in that profitability. So profitability in terms of acquisition cost. So Oken provides for lower acquisition cost. How? Because the network owner brings in the borrowers on the network. Otherwise, the lender would have been spending on various channels to acquire these customers. Next is lower cost of operations. With every loan that gets processed, there are different services which come in play, be it KYC validation, be it GSTN data, be it the bureau cost. All these services are getting cheaper day by day. And if you look at over the last few years, the cost has been coming down and will go down further. The cost also reduces with volumes. And that's pretty much evident in the trend line graph as visible on the slide. So the processing cost appears to go down by more than 50% with the economies of scale coming in play. The next impact on profitability that comes from lower delinquencies. And how does it come from lower delinquencies? The loans given in Oken are going to be small ticket, short tenor loans. So these are granular loans where there is purpose control, where there is collection control, and expected to deliver a high performing portfolio with lower delinquency. So this is how we can look at building highly profitable portfolios on Oken. So as we understand profitability, let's look at an example between a traditional business loan and a small ticket short tenor loan. For a capital of 10 crore getting deployed in two different loan products, one with a ticket size of 10 lakhs, another with a ticket size of 50,000, one with a tenure of 36 months, and that small ticket loan with a tenure of 3 months. Interest margin remaining the same, and even the processing fees coming down for a small ticket short tenure loan. If you look at the calculations in terms of the net total revenue earned on that pool of 10 crore, small ticket short tenure loans earn you more than 2x of revenue than that a portfolio would have earned in a traditional business loan. So that's the kind of profitability lenders can look at by rotating loans in multiple loan cycles for short tenures, which are much more predictable than a long tenure 3-year loan. And this being said, the assumption holds true with scale, and the scale will come with multiple networks coming in play. GEM is already live and the volumes expected are enormous, and multiple networks will soon go live and give an access to multiple set of borrowers for the lenders participating on Oken. So it becomes important to understand how the risk assessment can be taken up by lenders on Oken. So in terms of risk assessment, lenders need to move from collateral and financial data underwriting to information-based underwriting. Now, what is this information? Today, there is easy access to multiple data sets, be it the bureau, be it the GSTN or the banking data available through account aggregator framework, or the derived data, which will be provided by the network owner himself. All these data sets can be triangulated to create smart underwriting models by the lenders, which would be rich in terms of trying to evaluate a customer's capability and ability to repay the loans, as well as trying to understand deployment of capital in the right products. So richer data trail helps the lenders to evaluate the behavior of borrowers and try to build better underwriting models. With collection control and end-use control in place, lenders can efficiently deploy their capital and focus more on probability of transaction completion than on risk assessment. Credit guarantee APIs available at the application stage itself will help the underwriters to underwrite the risk much more efficiently and provide low-cost loans to this set of borrowers. It is already integrated with CGT MSE, and these credit guarantee APIs called by the loan agent at the application stage itself will flag those loans as eligible for CGT MSE. And this particular feature will help the lenders to underwrite the risk even more efficiently and provide low-cost borrowing to these set of borrowers. So as we understood the risk assessment part, let's understand how traditional lending and Oken underwriting models would be different. So historically, lenders have been relying more on financial data and asset as a collateral to underwrite risk, whereas in Oken, it's largely based on the cash flow information and the derived data available at the time at a transaction level. Traditionally, lenders have been serving the upper pyramid of MSMEs, whereas in Oken, we are trying to solve it right from the bottom till the upper strata in terms of getting the right products for these MSMEs. Earlier, the ticket sizes would be larger, the tenures would be longer. But here in Oken, we are trying to solve for very small ticket and short tenure loans, which meet the MSME's requirement. Earlier, the loan tickets would be high, the volumes would be probably low, whereas we are moving towards a velocity where the ticket sizes would be smaller, but the volumes would be higher. Earlier, the choice was pretty limited, where a borrower would be locked in with a single lender. Whereas in Oken, we are trying to open up the borrower's application for multiple lenders to give him an offer. It will be an auction-based model where lenders will be able to give their own offers and the borrower will have a choice to pick up the best offer that suits his requirement. In earlier models, there would hardly be any creation of data trail as such because the underwriting used to be largely paper-based. Whereas in Oken, it leaves a very rich data trail which lenders can evaluate and build the products which suit these requirements and also make their underwriting models smarter. The process in Oken is completely digitized end to end, right from the origination till disbursement. So as the underwriting models evolve and get built around information assets, let's look at a sample underwriting and scoring model for invoice financing. So let's look at this invoice financing, underwriting, and scoring model and understand how it has been built. So this is based on 4 data sets. First is bureau, next is invoice, third is GST data, fourth is bank statement data. Across these 4 data sets, we try to build parameters across each of them. For bureau, say it is score, unsecured credit inquiries, DPD instances, credit history. Similarly, for invoice and GSTN, there is data parameter across buyer's value contribution, buyer's compliance score. There is credit period offered, which is available from the invoice data, the HSN code in terms of the product that's being supplied, the bank statement data, which provides different parameters like credits to GSTN, check returns, the invoice amount to daily average balance. So all these parameters have been laid down in this particular model. We've tried to build cutoff criteria across all these parameters. Like for a score less than 670, it could be a reject. The responses are mentioned in the column E. Similarly, if the credit inquiries are more than 10, it could be a reject. And across all these parameters, the cutoff criteria and the responses. Now, responses could either be reject, they could be a restriction in terms of LTV, or they could be restriction in terms of tenure. Now, based on the particular borrower's response to that parameter, he could fall into either of the grades. So somebody who's falling in terms of bureau score as 720 would be in grade C. Or if he is more than 790, he would fall in grade A. So across all these parameters, a borrower would be a part of either of the grades here. Each of these parameter has been given a certain weightage, and the risk weightage here aggregates to 100% across these 19 parameters. Now, all these parameters have been drafted based on certain assumptions. The lenders are free to make any changes in terms of adding, deleting any kind of parameters here, or if they want to change the weights here in terms of the risk, any of these risk parameters, or if they want to make changes in the bands in terms of the bands being mentioned right from A, B, C, and D. Now, in this particular invoice financing model, we've also tried to show certain examples of certain set of borrowers who would have different grades across different data sources. So borrowers ranging into either of these scores may fall into different kinds of personas. And across all these results, we've tried to build a offer model here, where depending on the type of score a borrower may fall into, there would be an offer which will be displayed in terms of interest rate, in terms of the LTV that could be offered against that invoice, in terms of probability of default that's useful for the lender, and the tenor that could be offered to that particular invoice being presented for financing. So this particular invoice financing underwriting model we have built is available for you all and will be posted on the blog. And you can get started immediately with this particular model. The risk teams are free to do any changes, as we mentioned earlier, in terms of trying to tweak these parameters, change weightages, or try to differentiate their parameters depending on the risk policies. And with this, I would like to hand it over to Sagar to take it further from here.
Thank you, Rahul, for walking us through the underwriting model. This is a sample model will be made available to you via our blog. We've also published other blogs which might be useful information for you to get more insights into how Oken works. We've been maintaining all the documentation on oken.dev. Loan agents bringing you a lot of scale as a lender. Question comes on how to prepare for this massive scale. Clearly defined network policies on who to engage with, what kind of loan agents work, what are the areas that are of interest in terms of lending. Segmentation, some might go after agri-business, some might go after dairy business, some might want to work with a different sector of manufacturing-based SMEs, some would work with the anchor kind of financing, and everyone will find their niche. I can't stress more upon the importance of underwriting model. With database underwriting becoming the new norm in the cash flow business, underwriting models are going to be the key differentiator for every lender. Underwriting models would become more and more complex with dimensions being added. Rahul just presented a 4-dimension model, but there will be more and more dimensions that will come across, mostly provided by Oken, but some might even come through your proprietary sources and in-house business that you've been doing. These models will get resilient over a period of time as you give loans and you learn more from the loans. The weights that Rahul showed will get adjusted on who does better and what parameters score fare better compared to the previous ones. Borrower profiles. We're talking about MSMEs here, but there are various segmentations of borrower profiles, some pertaining to a geography, some pertaining to a network, some pertaining to a particular line of business, some pertaining to a transaction. Clearly defined borrower profiles will help you scale, will help you understand that borrower profile better, reducing the delinquencies and managing it. The amount of scale that will come with Oken cannot be just handled by the current operations heavy business. Digital being the primary channel of operations in the cash flow lending business, a good digital workflow or a clearly defined digital workflow is going to give a lender edge over the other lender while achieving operational efficiencies. The cash flow lending business thrives on operational efficiency and lower cost to serve. Defining digital workflows, continuously monitoring and tweaking them by dedicated smaller teams will overall help you scale in the Oken world. These teams might not just be restricted to monitoring and processing digital workflows. They could take handoffs from digital workflows where human intervention is required. They would monitor and probably help change policies, help discover other networks that are there on the registry, help monitor and change weights in the underwriting models, monitor and tweak borrower profiles, and they overall ensure your success in the larger volume. For Oken and cash flow lending, to achieve its true potential, we seek some help from the regulators. Making some changes to the digital lending guidelines will help the overall ecosystem. We seek formal recognition for the BA role versus the current definition of LSP. Clearly differentiating between the LSP and the borrower agent will help gain borrower trust, increase the transparency in the lending business. The KYC issue is well known in the digital lending business. Making some changes to the KYC will help lending institutions seek and provide credit to customers for which KYC is going to be digitally possible. In the current ecosystem, banks and lending institutions provide online offers to existing bank customers, but to unlock the potential of Oken and venture into new networks, the new to bank customers need to be offered, and solving the KYC issue is the first step towards it. As the digital business in the cash flow lending business scales, the regulator will need more tools to help them look at issues better. Use of real-time regulation is going to be a key to success for the regulator. In the current model, the regulators get the information after the issue has occurred. But providing a real-time sneak peek into data on exposures within networks, products for a particular lender is going to be very important for regulators to look at issues in the digital ecosystem. Escrow-based collections are very important to the success of Oken. Like we saw earlier, T4 products reduce the risk of collection significantly. While escrow-based collections might not be a good thing for consumption-based loan, but it's a very normal practice in the business world. Providing specialized provisions for cash flow lending business will help the lenders get more trust and provide more credit to the borrowers. Bringing guidelines to report cash flow loans to the bureaus is going to be important because they are not categorized within the current bureau framework. These are short tenor loans, do not qualify for 1 year working capital loans or revolving credits. Having looked at how to succeed in the cash flow lending Oken world, let's look at the opportunity that lies ahead. According to the RBI UK SINA report, there's a 20 to 25 trillion credit gap in the current MSME lending market. Only 11% of MSMEs have access to formal credit. More than 60% of their demand is unmet. This is because of three key barriers that are highlighted in the report. A lot of these borrowers, or almost all of these borrowers, are perceived to be high risk basis the current underwriting models. There is high cost to serve because of lack of remoteness. We already looked at how the risk can be mitigated with information collateral. The cost can be reduced by loan agents and shared borrower correspondence. And lenders can be remotely operating in multiple loan networks. We've been working on Oken for a while. We've done pilots. It's only fair that we publish our learnings from the pilots. There was a lean period for Oken during which we were doing this study and not bothering to scale. With the launch of OCEN 4, we are looking at scale. But these learnings will help you scale with OCEN 4.0. There are two key learnings from the GEM pilot. Loans are revolving in nature. By that, we mean same borrower could take a lot of repeat loans for a very small ticket size. But when you look at the total value of loans for a given period, which is a bigger slice of time, which is either maybe a 6 months or a 1 year window, the amount is fairly significant. Let's look at an example. A particular borrower took 68 loans for a total value of 21 lakhs odd, with an average ticket size of 30. And there are similar examples in the rows below. These borrowers wouldn't have got loan for the ticket size they were looking, even in a metro city. But these borrowers were not even from the metro city. They were from remote locations, remote areas of Andaman, Manipur, and Jammu and Kashmir. They've managed to get loan because of a good borrower agent. At this point in time, the lenders do not have to worry about repayment because there are escrow-based collections, and they only have to worry about whether the borrower is going to be able to complete the service on the GEM portal. There is immense trust in GEM to repay the loan, and it is collected via the escrow mechanism. Like I mentioned earlier, we've been at this for a while now. We've had 2 implementations, or probably some more, which are using the Oken APIs underneath. The GEM marketplace and the Kisan credit card that was launched by the Karnataka government. They underneath use the Oken APIs. In the cash flow lending business, there is a lot of closed networks operating and businesses currently happening. Eventually, when APIs are standard with the Oken framework, with discovery on the product registry and product networks, participants will move on to a more open system versus a closed system. One more added benefit of coming to the Oken ecosystem is that you could integrate only once with the APIs and you could serve as a participant, you could serve in multiple loan networks and loan products. As a lender, the only delta is probably looking at changing and tweaking the underwriting model for that particular network. And that reduces both the operational cost and the time to market for a new lender. They could do a lot more experiments in this manner. Let's look at a diagram from the UPI market. When we draw parallels from the UPI case study, while UPI was a flat line between August of 16 and September of 17, the white line indicates the point at which UPI transaction grew. A lot of participants who implemented UPI after the September of 17 were not able to scale or do better compared to the people who adopted the UPI framework. It is because there were immense learning during August of 16 and September of 17. We are at a point which is similar in the Oken ecosystem. We request you to participate in the wave 1, experiment, learn, and scale. Let's look at some of the areas which we feel will help you achieve better success in the cash flow lending business. Participating and learning early, we looked at in the previous slide how that is going to be very important. But let's look at one more important point. Apart from the learnings, when you participate early, you get data in your system. Data is going to be very crucial for your underwriting models because they are information-based underwriting models. These models will get resilient over time. It will only be difficult for new entrants to compete with models which are proven and successful. Digital workflows and underwriting models will be the key differentiator for any lender in the digital world, reducing costs and bringing about operational efficiency, thereby having a larger share of profits. One more request is what we do is what we have to make is for embracing new business models. There will be a lot of models that will come up while you interact with other participants. Some of them will succeed and eventually become standard over a period of time. But do not make a business model unless it is less profitable to be a deterrent for you to enter into a particular network. With this, we conclude the lender open house. However, we understand that you might have queries and suggestions. You could reach out to us via our website, oken.dev. There is a contact form. Any suggestions, queries are welcome. Even participation is possible with the same form. We will get back to you surely with all the queries and answers to your queries. These are exciting times for the cash flow lending business. This might be a start of a revolution. We request all of you to participate, learn, scale, and benefit from. Thank you.